Hello financial fans, welcome back to another stock analysis. Today we'll be covering PayPal, stock ticker PYPL. PayPal is an online payment system that allows individuals and businesses to make and receive payments over the internet. The company was founded in 1998 and is headquartered in San Jose, California. PayPal's platform allows users to send and receive money using their email addresses, phone numbers, or a PayPal account. The platform also supports online payments for e-commerce sites, and it enables businesses to accept payments from customers all around the world. In addition to its core payment services, PayPal offers a range of additional tools and services such as invoicing, payment processing, fraud prevention, and international payment processing. The company's goal is to provide a secure, reliable, and user-friendly platform that makes it easier and more convenient for individuals and businesses to send and receive payments electronically. They currently are sitting at an $88.4 billion market cap, and in 2022 they generated a revenue of $27.1 billion. 93% of their revenue is generated through transaction revenue, and the remaining 7% from other services that they offer. 53% of their revenue is generated from the United States, 11% from the United Kingdom, and the remaining 36% from various other countries around the world. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 20% that can never be below 0%. And the margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up, going from almost $1.1 billion in 2013 to $4 billion in 2022. The average EBIT growth during this period was 16.4%, and that's a 5% deduction from a margin of safety. The margin has gone down, going from 16.2% to almost 15% in 2022. The average margin decline was 0.6%, meaning no change in the margin of safety for this metric. The final two ratios that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, you have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. As you can see on the graph, the debt is slightly smaller than the cash, meaning that PayPal can pay off all of their debts with their cash position. This gives them a 0% debt to EBITDA ratio because PayPal has no net debt. And this is a 5% deduction from a margin of safety. The return on invested capital for PayPal is sitting at 12.4%, meaning another 5% deduction from a margin of safety. Looking pretty good so far for PayPal. So let's go look at the valuation models next to determine the intrinsic value of PayPal. The first model that we'll be using is the discounted cash flow model. I've imported the free cash flow of PayPal going from 2013 to 2022. The average growth in free cash flow annually during this period was 22.5%, and I'm projecting an expected growth rate annually in free cash flow of 10% over the next 10 years. This way we can determine the future free cash flow for PayPal and determine the terminal year valuation using a perpetual growth rate of 3% and a discount rate of 9%. This leaves us with a sum of free cash flow of $135.5 billion. And to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $136 billion. Also have to do to get our price per share out of our discounted cash flow model is to divide it by the amount of shares outstanding, and this leaves us with a price per share of $120.38, which is a 54.3% upside from the current price. The second model that we'll be using is Graham's revised valuation formula. In this model, we look at the earnings per share that PayPal is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds. And we go by the theory that a PE of a company with no growth is at 7. Looking at all of these metrics, we get a fair value out of this model of $44, which is almost a 44% downside from this model. The third model that we use is the multiple valuation. In this model, we look at similar companies to PayPal, look at their stock price and the earnings per share to determine the average PE multiple in the industry, which in this case is 33.88. All that's left to do to get our fair value here is to multiply by the earnings per share that PayPal is generating, which gives us a fair value of $67.76, which is a 13% downside out of this model. And the final model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this is the PE ratio. In this case, I've imported the PE ratio of the past 5 years, and the average PE multiple during this period was 51.71. And the current PE ratio is 38.96, meaning that it's currently trading under the mean. This indicates that it's undervalued. And the fair value out of this model is $103.53, which is almost a 33% upside out of this model. Let's go look at the final overview of all of our valuation models next. Looking at our final overview, we've imported discounted cash flow, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, leaving us with an average of $83.92. We've determined our margin of safety earlier by using a standard margin of safety of 20%, deducting it by 5% for the debt to EBITDA, the EBIT growth, and a return on invested capital, leaving us with a margin of safety of 5%. Adding this margin of safety to our average out of all of the models, we get a fair value of $79.72, and with the current price of $78.01, we had a small upside of 2.2%, meaning that is trading very close to fair value at the moment. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.